Hello traders, and welcome back to our Babypips course for today. It's interesting how far we've made progress. We've completed course 1 of 11, we've completed course 2, course 3, we've completed also course 4, we've completed 5, 6, 7, undergraduate freshman, 8, undergraduate sophomore, and 9 we just completed it, and today we're going to begin from course 10, undergraduate senior. And here is the course outline: risk management, the number one cause of death of forex traders, position sizing, setting stop losses, scaling in and out, currency correlations. So on the undergraduate senior, we are going to learn about all these under risk management. Okay, so 1, 2, 3, 4, 5, 6, and that will be all for course 10. So let's begin by looking into risk management and what we're going to learn under risk management. So we're going to learn what risk management is, how much trading capital you need for forex trading, drawdown and maximum drawdown explained, never risk more than 2% per trade, then risk to reward ratio, study your losses to realize gains, then summary of risk management. So without much ado, let us dive right into studying risk management by answering the very first question that says, what is risk management? But before we move on to answer that question, roll the intro. So welcome to risk management. Now the first question is, what is risk management? Now risk management is one of the most important topics you will ever read about trading. Okay, now why is risk management so important? Okay, if we don't learn how to manage risk or manage our money, okay, we are going to lose the money. Now everybody's in the business of making money, right? So in order to make money, you must learn how to manage your risk. Okay, so that's why risk management is very, very important, especially in forex trading. But guess what? Risk management is one of the most topic that is easily forgotten. Many students, many people, once they learn how to buy and sell, learn a few trading techniques or trading styles, the next thing they jump the gun and then they go start trading live, but they haven't really learned about how to manage their risk or manage their money, which is risk management. And this is one of the reasons why many traders lose money, because when you don't learn how to manage your risk, if you just go and say, well, I can shoulder this loss and all that, okay, it's called gambling. Okay, this is the type of investment that's called gambling. Don't just put your money into the forex market. Okay, learn how to manage your money. So when you take a trade without risk management rules, you are gambling. Just like those who go to the casino, they go there with hopes of winning money. And of course, some people do make money, okay, but the majority of the people who don't make money, they are the reasons why the casinos, they are always rich. Okay, like Bob might win a jackpot, but what about the other people who don't win jackpots? That's why they say the casinos always win. Okay, now the casino always win. That is true because the majority of people who lose, they are much more, and the chances of people losing in casino is greater than the chances of those who win a jackpot whatsoever. Okay, so if you learn how to control your losses, you will have a chance at being profitable in trading the forex market. Okay, forex trading is a numbers game, meaning that if you have to tilt every little factor in your favor as much as you can, do it. In casinos, the house edge is sometimes only 5% above that of the player, but that 5% is different between being a winner and being a loser. You want to be like the rich statisticians who own and runs casinos, okay? And in the long run, you will always be a winner. I hope you understand what we just discussed here. Be smart like casino owners, okay? Have the slight edge in your favor, and with that slight edge, you are going to be a winner. But if you are not using that slight edge as the statisticians do, the rich casino owners do, instead of being a rich statistician with a slight edge on your side, you are going to be the loser, falling down. Why? Because you failed to understand what risk management is, how to manage risk, how to manage your money, and how to be on the slight edge of winning every trade. It is that slight edge that's going to make you consistently profitable. So now let's move to the next questions that says, how much trading capital do you need in the forex market? So how much trading capital do you need for forex trading? Now the simple answer is this: it all depends on you. Why? Because you might want to do this on your own. You might want to get a mentor. You might want to get a class. You might want to buy some tools. You might want to buy some signals. It all depends on you. If you join a great mentor who has a class, okay, the importance of that is that it is going to shorten your learning curve. So what you're going to learn for 10, 5, 3, 4, 6 months, you can learn it in a month or in 2, okay, and it's going to benefit you. Now the other side of this benefit is that it's going to cost you a huge fee upfront, okay, like you have to pay some money to be mentored, okay. So it all depends on how much your mentor, okay, charges. So how much you're going to put into your account, it all depends on you. If you are going to pay for subscriptions from other platforms, for some signals, some news, and some information, some data, it all depends on you. All those that are going to accumulate to start up your trading account. Now many forex brokers, okay, they offer minimum deposit accounts of $25, but that doesn't mean you should start trading immediately. Why? Because $25 is not really much money. Now this is called capitalization mistake, which often leads to failure. Losses are part of the game, and you need to have enough capital to weather these losses. So let's be honest, if you are consistent and you practice proper risk management techniques and stick to trading micro lots, then you can probably start off with $5,000 to $10,000 in trading capital, okay. But if you have $25, you have a good mentor, you are good to go also. So now let's look at the next lesson that says drawdown and maximum drawdown explained. But I don't have it here. What's going on? So here we are on drawdown, maximum drawdown. I lost connection. I just connected back. So talking about drawdowns and maximum drawdown, what does this really mean? Now, if you have $100,000 account and you lose $50,000, okay, your account is gone half, right? Now that is drawdown. When you lose a certain amount of money that amounts to half of your investment capital, that is a drawdown. So this is normally calculated by getting the difference between a relative peak in capital minus a relative draw. Now, a losing streak. A losing streak is the number of trades you lose before you win. Okay, so in trading we are always looking for an edge, and that's why many traders develop trading systems. Now it doesn't mean your trading systems must be good or perfect all the time. In fact, even if you have a trading system that is 70% profitable, it might sound okay, great, but that doesn't mean you're going to win all of your 70 trades and then you just lose 30 trades. No. Okay, so in 100 trades you might lose 30 straight before you win the next 70. That's what we're learning here. Okay, so How are you going to be able to stand long or stand the test of time in the forex trading market? Now, this is the reason why you have to practice proper risk management. It is so important. Why? Because no matter what system you use, you will eventually have a losing streak. Maybe 1, 2, 3, 4, 5, 6, 7 trades losses. Okay. Now, even professional poker players who make their living through poker go through horrible losing streaks, and yet they still end up profitable. How is that even possible? Because they practice risk management. They know they are not always going to win every trade, every game or every tournament. So they risk only a small percentage of their total bankroll so that they can survive those losing streaks. Now, this is what you must do as a trader. You must risk only a small percentage of your account to survive those trades that you will lose. Now, drawdowns are part of trading. Now, the key, or what you must do to become a successful forex trader, is to come up with a trading plan that enables you to withstand these periods of large losses and having a good risk management rules in place. Now, only risk a small percentage of your trading account or your trading bankroll. Why should you do that? So that you can survive losing streaks. Remember, if you practice strict money management rules, you will become the casino, and in the long run, you will always win. Believe me, what they are saying here, I have heard it many times from many professional forex traders. Okay, only risk a small percentage of your trading account, and in the long run, you will always win and survive when you lose 1, 2, 3, 4, 5. No matter the number of trades you lose. Once you practice the risk management rules, you will always win and you will always survive in the forex market. So let's go to the next page that says never risk more than 2% per trade. So here we are on never risk more than 2% per trade. Now, how much should you risk per trade? Try to limit your risk to 2%. Why? In this chart, you're going to see the difference between risking 2% versus 10% per trade. So let's say this part is a 2% and the opening balance is 20,000 US dollar, and this part is 10% per trade, that is the risk, and the opening balance is 20,000 US dollar. So if you risk 2% of 20,000, that's $400 per trade. If you risk 10% of 20,000, that's $2 per trade. Now look, supposing you go through a losing streak, what will happen? If you have gone through a losing streak of 19 trades in a row, okay, and you are having a account balance opening of 20,000 US dollar, you will have only $3,000 2 cents left if you risk 10% per trade. Now you would have lost over 85% of your account. Now if you risk only 2% of the same amount account balance, you would have 13,900 US dollar left, which is only about 30% of your account. You are not yet on a drawdown, okay? You still have lots of money in your account. So the last thing you want to do is lose 19 trades in a row. But if that sort of thing should happen, okay, you don't want to be on the side of losing 85%, rather 30%. Okay, so you just want to be wise and be safe. The point of this illustration is that you want to set up your risk management rules in a way that when you have a drawdown period, you still have enough money and enough capital to stay in the game. Now, what do I do to have to get my money back, or to get back to break even? Look at this chart here. Capital that you have lost. What is required to get it back? It's 11%. If you lose 10%, you need 11% to get it back. If you lose 20%, you need 20% to get back 20%. You need 25% rather to get back 20%. And as you can see, it is really, really difficult to get back. Okay, so instead of going in the wrong way, it is better to start out rightly. So starting out rightly means applying the rules. And rule number one: don't you ever risk more than 2% of your account. Be like the house, be like the casino that always win. You don't want to be the gambler. It is a game of numbers. You want to be able to stay in the game for the longer period of time. So you are a statistician. You understand the importance of staying in the game for a long time. For that's how you're going to be consistently profitable. The next lesson talks about risk to reward ratio. So here we are on risk to reward ratio. Now the rule is this: you want to take a trade when you have the potential of making 3 times more than you are risking. So give yourself 3 reward to 1 risk ratio. Okay, now this is how it looks. Let's say you lose 1 trade, you win 1. You lose 1, you win 1. Okay, so if you lose $1,000, when you win you should make a $3,000, and that's a 3 to 1 risk to reward ratio. It is very, very important. Many traders, they do this, especially the professional ones. Okay, so using a 3 to 1 risk to reward ratio means that you need 9 pips, okay, to be able to reach or take profit. Now you need 9 pips. That is if you are risking, or you wish to risk just 3 pips alone. And this is that about this section. Okay, it is not much to explain about here. I'm sure you also know risk to reward ratio already, but if you don't know it, it means that if you risk 1,000 US dollar, you should be able to make 3,000 US dollar back in profit. So that takes us to the next lesson that says study your losses to realize gains. So here we are on study your losses to realize gains. Now, traders are often fixed on their winning trades that they totally ignore their losing trades. But it's from your losing trades from which you stand the chance to learn the most. Now, there are 3 ways you can do this. Number 1, calculate your performance. Now, look at your past trades. Now, if you can't find them, ask your broker. Then gather the data. Gather the data, your profit and loss data, so that you can begin to analyze, the factors affecting your overall trading performance. Now, the first thing you want to do is find your average gain. Now, your average gain, you can find it when you get the total number of your gains and divide it by the number of profitable trades. That's your average gain. Okay. Next, find your total loss. Now, your total loss is your average loss, which is your total losses divided by the number of unprofitable trades. Okay. Now, once you have both numbers, okay, let's display those in terms of ratio, so you can begin to dig deeper into your profit and losses and know where they are coming from. So profit and loss ratio is your average gain divided by your average loss. For example, let's say you had 10 profitable trades with an average gain of $200 per trade, and 5 unprofitable trades with an average $300 loss per trade. Now, your profit and loss ratio is this: $200 divided by $300. Your profit and loss ratio is 0.67. Now, a profit and loss ratio refers to the size of the average profit compared to the size of the average loss per trade. Now, in the above example, since your average gain is $200 and your average loss is $300, your profit and loss ratio is 0.67. This means that your average profit is only 67% of your average loss. Now, if you want to put it differently, you lost 1.5 times more money than you gained. That is $300 average loss versus $200 average gain. Fortunately, you won 10 trades out of 15. Now, your average percentage win was 67% using our example. So your win percentage is the number of profitable trades divided by total trades. Now, you had 10 trades you lost 15. So 10 divided by 15 is equals to 0.67 or 67%. Now the average gain versus the average loss per trade also tells you how well you are managing and closing out your position. So if your average loss is more than your average gain, ask yourself, oh my god, no, this ain't gonna work. So if your average loss is more than your average gain, ask yourself, do I generally stick to my original trade plans or diverge from them? When my trades are profitable, what influences my decision to exit? When my trades are unprofitable, do I exit according to my pre-planned risk management rules or hold on to losing trades too long? Now, answering these questions, you can identify weaknesses and build better trading habits over time. Now, drill down on your losses. Now, if you want to learn from your past mistakes, you need to pay extra close attention to your average losses because you have the most control over them. Even when you do your homework, a position might move against you, of course, and then it can turn into a loser for you. So it's how you manage and control these situations that can make or break your success as a trader. Okay. Now, if you found yourself in situations in the past and sit back and reflect on how long and why you allowed the position to fall before you acted, you can, get some ideas on, how to improve and not to let that situation repeat itself. So focusing on your average losses will help you identify a bad habit in your trading approach that is probably contributing to mediocre results. Now, most likely, you are letting your losing trades run for too long. You probably need to cut them sooner, cutting your trades short sooner, cutting your losses, like closing the trade as soon as possible once you've known that you are in a losing trade. Now, try exiting a losing trade position before it reaches your average loss. You may experience an immediate improvement in your performance. Okay, exiting a losing trade before it reaches your average loss. By doing this, you may experience an immediate improvement in your performance. Okay, instead of regretting, the money, I'm losing the money, let me not lose the money, let me wait for it to get back up. No, cut the trade short, cut it, close the trade as soon as possible. Okay, and take a very small loss instead of a huge loss. Now, it's possible to be wrong more than one time, okay, and still come out ahead. But if your average gains need to be way bigger than your average losses, basically you may not be right often. But when you are really right. Now, the easiest way to track this is by figuring out your trade expectancy. Now, calculate your trade expectancy. Your expectancy is the average dollar amount you expect to gain or lose per trade based on previous performances. Now, it combines your percentage of profitable trades and average gain per trade with your percentage of losing trades and average loss per trade. Now, your expectancy is the percentage of winning trades multiplied by your average gain minus your losing trades multiplied by your average loss. Now, for example, let's say 30% of your trades in the past 3 months were profitable and your average gain was $300 per trade, while 70% of your trades were unprofitable with an average loss per trade of $100. Based on the above calculation, you should expect an average gain of $20 per trade. Now, your expectancy is 30% times 300, okay, minus 70% times 100. Now, your expectancy is $90 minus $70. Now, when you minus this is 20. Okay, so even though you lost a lot, okay, but you still came out with some money. Now, from the example above, your aim should be to increase your positive expectancy with each trade. Okay, now if the opposite is happening, revisit your losers to see where the breakdowns might be occurring. Now, a lot of new traders are so obsessed with their profit-loss ratios that they are unaware that a bigger picture exists. Now, your trading performance depends largely on your trade expectancy. Your trading performance depends largely on your trade expectancy. Now, in summary, examine your performance on a regular basis and understand the better behaviors and other factors that may be influencing your trading outcomes. Paying close attention to losses is a great way to identify any shortcomings. We went through this little by little so that we can really understand it, and I'm not going to go back to it again, but I would love for you to come back and study your losses to realize gains. Do all this work here, okay? Go and look your MetaTrader 4, look at your trade history, look at your trade performance, look at the trades you won, look at the trades you lost. Put all of them down in writing and do the hard work. It's going to help you a lot. In fact, I'm going to do it as well because I'm still learning, you're learning, okay? So let's look at the next lesson that says summary risk management. So here we are on risk management, okay? So be the casino, not the gambler. Remember, casino owners, they are very rich statisticians. They work with statistics, okay? So it takes money to make money. Everybody knows that, but it depends on so how much you need to get started in trading depends largely on you and how you are going to approach your new trading business. It varies from person to person, okay? So drawdowns are a reality and will happen to you at some point. The more you lose, the harder it is to make it back to your original account size, okay? So this is the reason why you should do everything you can to protect your account. Now, we hope that it's been drilled down into your head that you should only risk a small percentage of your account on each trade so that you can survive losing streaks and also avoid large drawdown in your account. Big drawdowns usually mean a quick death of your trading account. The less you risk on a trade, the less your maximum drawdown will be. The more you lose in a trade or in your account, the harder it is to make it back to break even. So this means that you should only trade only a small percentage of your account. The smaller, the better. It's much more better that way. Less is more. So 2% or less is recommended. 2% or less per trade is highly recommended guideline for everyone to follow. You said guideline because it depends on other factors like your experience, your trading system, and how often it takes a trade. Okay, now the more currency trades you take per time frame that you focus on, the less you want to risk per trade. Okay, so let's say you take 5 trades in one particular currency, risk less. Okay, so lastly, don't forget to factor your trading according to market volatility that is always on the change. So that brings us to the end of lesson 10.1. I'll see you in lesson 2, but before we do so, please, if you haven't subscribed yet or smash the like button, please do so. If you like the video and you appreciate all we've been doing so far, smash the like button for me, subscribe if you haven't, and until next time, I'll see you in 10.2.